Hi there, and first of all, thank you very much for your interest in the Avendus Enhanced Return Fund. Now, before I talk about the fund in more detail, I think it's very important to understand the skill set of the team in managing long-short strategies over the years. So we first started, me and the core team at Merrill Lynch in 2006, running about $500 million in a long-short strategy. And then we moved to Ambit in 2009, and in 2013 launched the first hedge fund in India with about 20 crores. And by the time we left Ambit, the fund was about 1,200 crores. And then the team, all of us, moved to Avendus, and then in March of 2017 launched the same strategy, which we're running from our Merrill Lynch days. As of today, that fund is around 4,350 crores, and unfortunately it's not open for any more subscriptions. But what we were trying to do in that fund and the long-short strategy was to achieve gross returns of about 15 to 20%, irrespective of whether the market goes up, goes down, or goes sideways. And that's something we managed to achieve throughout that 13-year period. But there has been, what are the risks? And have we managed to do this in more difficult markets? Well, we have had difficult markets like 2008, obviously the financial crash. 2011 was a very bad time for the Indian markets. It fell 25% in that year. 9 out of 12 months the markets were down. 2013, the currency crisis. And then 2015-16, when you had the China devaluation of the yuan, and you also had the commodity crash as well. Oil prices were nearer to $20. So throughout those kind of periods as well, the team hasn't managed to lose money in any one year, any one quarter, or any 2 consecutive months. So what the team has done over those 13 years, in good times and the bad times, is be able to manage risk. And that's the important point which I want to kind of emphasize here is our skill set in managing risk. So now, turning back to the Avendus Enhanced Fund, basically what we're going to try and do there is manage the equity kind of risk side of the portfolio. So if you give me 100 rupees, 70 rupees will go into 15 to 20 high conviction, long only stocks, which we'll hold for the next 2 to 3 years. This is based on our proprietary screeners, which will take the top 200 companies and then really kind of screen them for cash flows, ROAs, ROEs, and basically you get down to about 35 companies, and then we do our top-down, bottom-up analysis to get to our 15 to 20. So those will remain fixed. And then with the 30 rupees, this is where we'll use our long-short expertise in 3 ways. Let's say the market is going to fall. The market's going to remain, say, range-bound, or the market's going to go higher. So the first scenario, the market's going down, I'll use the 30% or 30 rupees to hedge the risk of the 15 to 20 stocks, or the 70% of the stocks. If the markets are range-bound, I'll go back to do my normal long-short, which I talked about before, where we're aiming to get 15 to 20% returns anyway. And if the markets look as though they could go higher, I can use that 30 with some leverage to increase the overall long side of the portfolio from 70 to 100 to maybe 130 on the long side to enhance returns. So basically what this fund will do over a 3-year period, it's a 3-year closed-end fund, is if the Nifty was to rise by X, and let's say X is 50%, then we would aim to do 1.5 times 50%. So our returns would be nearer to 75%. But importantly, over that 3 years, there's going to be periods where markets fall, up to maybe 10%. So the aim and the endeavor here is to limit that, kind of downward loss, not to 10, but to 3. So 1/3 of the losses in the market. So what's been the track record so far? So we launched started deploying money in December 2017. And between that period and January, the market rose by 8.5%. Because we were still deploying funds, we'd only managed to return 4.25%. And February and March, I think you remember that markets fell nearly 10%. And in that period, our fund only fell 0.2%. So if you now go back to December to March, the market was actually down 0.8%, and we were still at 4.2%. So what I'm trying to say is that we managed to, limit the downside when markets fell sharply. And then when the market rose in April by 6.1%, our fund rose by 7.1%. So net, we are up 11.5% and the market's up 5%. And if you compare that with any kind of long-only fund, mutual fund that is, top 5, the returns there would be nearer to 2.5%. So this is very much after your equity in terms of your funds. And you can really, it competes really with your long-only mutual funds. So it's to give you equity, enhance your equity returns while minimizing your equity risk. So I hope that's given you a flavor of the fund, and we hope to see you as one of our investors. Thank you very much.